In this video, I'm going to review two quality stocks trading at 52-week close. Try to tell you if these two stocks are good buying opportunities or not. A lot of you have asked me about them. One of them is a popular one I've talked about. I'm going to give you my opinion if I believe it's a buy or not. The second one is a stock I've never discussed, and it's a very interesting stock, quality stock that I believe is somewhat fairly valued. And I'm gonna keep the video short, give you a very quick opinion. I don't do 20-minute videos, try to put as much ads as possible. I like to get, straight to the point. And I really hope you enjoy that stuff. But before I begin, I just want to say again that I'm not really against like all quality investing. I'm just against overpaying for quality, just like I was against overpaying for growth. I think you could always lose money if you overpay for whatever reason you're buying the stock for. And before, we had a notion where you cannot really overpay because the company will grow into the overvaluation. This has ended in 2022, and now we have a notion or a thesis for most investors that you cannot overpay for quality. Like you can't lose money overpaying if it's a quality company. It's ultimately going to grow into the overvaluation because of high return on invested capital. And maybe that's true, and it could take a long time. I mean, you could look at MSCI, it's been flat for 3 or 4 years, and there's MasterCard hasn't done the best. And there's so many examples of what happens when you overpay for quality. But I'm not against quality investing. Some stocks are fairly valued. I talked about Visa, we talked about Pfizer, we talked about many quality stock trading at fair value. And that's why I'm going to assess those two stocks today. The first one is LVMH, ticker symbol LVMUY. I'm not going to give you an entire introduction on the stock. A lot of you know the things that they own and the brands and very popular stuff for LVMH. So I'm not going to give you a huge introduction. The stock is down. I mean, it's even up a little bit year to date. It's down 20% over the last year. This is a stock I bought in early this year. I bought it at 145. I sold it like 183, 184. And now it's coming back to earth. It's sitting at 158. And a lot of you have asked me about it. The last quarter it wasn't too bad. They grew 3% total in terms of organic, which was very good for this company in this slower economic environment. I mean, I wouldn't be surprised if this quarter is negative. A lot of those companies have been suffering, and they report earnings next week, I believe. So I'm going to be watching it in case we get an overreaction and I get another buying opportunity on LVMH. But they did decline a little bit in Asia. I personally believe they will likely decline in the United States this time, but I'm not sure. So we're going to see about it. Again, to keep the video short, if I look at LVMH over here, and I look at the analyst estimates for EPS growth between 4, 11, 8%, all over the place. But realistically, I wouldn't bet more than 8% in terms of earnings per share growth. So we get around 8% earnings per share growth. They have a dividend like 2%. Let's say that's like a 10% annual return. But then you look at the multiple of LVMH, it's still sitting at 22 times earnings. 22 times earnings for such growth, for me personally, is a little bit expensive. Now you have also Nike trading at 22 times earnings, and it's not growing as fast as LVMH, and the margins are much lower than LVMH, but it's also trading at 22 times earnings. So on a relative basis, LVMH relative to other, you could say apparel stocks or cyclical stocks, you could say is somewhat fairly valued for a quality company. But for me personally, as I'm not really willing to overpay for that stuff, I believe LVMH is somewhat overvalued at 22 times earnings. It's not the best bargain ever. When I bought the stock, it was like 19 times, 19.7, 19.8 times earnings because the estimates were higher. Now the estimates came down and it's sitting around 22 times earnings, which for me personally is somewhat overvalued. If I had to personally buy LVMH, I wouldn't pay more than $140 in this specific environment. And why would I? There are so many better opportunities. We talked about McDonald's and others. They're trading cheaper than LVMH, and their model is a little bit better recession resistant, and they have franchise stuff and pricing power and high margins. So why would I overpay just to own LVMH? For me personally, it doesn't make sense. There's way better value. If I had to buy LVMH, I wouldn't pay more than $140, $145 maximum, which is like 11.5%. And we're getting earnings very, very soon. I believe it's in a week or two. So we might get some kind of an overreaction and get an amazing buying opportunity on LVMH. I would definitely be taking advantage of it personally. Of course, you have the stuff that's happening in France in the elections, and they want to tax like 90% income tax rate or something crazy. And I can't really predict how this will affect LVMH in France. So I'm not going to comment on it too much. But looking at LVMH, a little bit overvalued for me. 140, 145. For me personally, LVMH would be a buying opportunity at this price. Now, this is another quality company, and it's a very interesting one. Someone suggested this stock to me, and I got a lot of questions around it. And it was mainly a spin-off, I believe, from Johnson and Johnson, and it's sitting at $18. This is a stock called Kenvue. I think this is how you pronounce it. Kenvue stock, $18 per share. It's been horrible. It's down 15% year to date. The stock is down like 30% from when it went public, which was last year in 2023. And the company has one of the most popular brands you ever heard of, like Tylenol, Motrin, Nicorette, and Neutrogena, and Listerine, and Johnson, and Band-Aid. I mean, all of us know those brands, and that's just amazing branding power. Very popular brands that they own, and Aveeno, Neutrogena, just amazing stuff. Most of us know those brands, and all of them now are in Kenvue, which spun off from Johnson & Johnson. Very good stuff. For organic growth, it was only 1.9%, which is not bad on the surface. But if you look beneath the surface, you see that they're having some trouble in the skin health and beauty stuff. So the makeup, skincare, and they're facing a lot of competition from companies like Elf Beauty. And there's so many companies, especially online, selling on Amazon, selling on different places. So a lot of people, they just don't want to overpay for Neutrogena, and they would rather maybe buy something like Elf Beauty stuff, which is a little bit cheaper, or maybe they buy something else. There's so many brands to choose from, and they're facing over a 6.9% volume decline in this area. And normally, most of those companies, they face decline in their brands, but they offset it by raising prices. For example, like Pepsi does with the Pepsi stuff, like Coca-Cola does, like Procter & Gamble does. But for something like Kenvue, they can't really do it with the skin and health. They were able to increase prices only 2.4%, which led to a decline of 4.5% organic. That was very, very bad. But you have the essential health in terms of the Band-Aid and self-care. They were able to get overall a positive organic growth, 4.2%, 4.9%. But skin and health, which makes up 1.1 billion, is extremely weak in the company. And they're just facing so much competition. And this is something you have to keep in mind. Now, for the balance sheet, normally whenever you have a spin-off, the parent company tends to offload a lot of the debt on the new company. Kind of what happened with AT&T and Warner Bros. Discovery. And most spin-offs are this way. It's a way for the company to either raise some money or to offload a lot of debt on the company. And this is somewhat the case with Kenvue. Although they paid some of it off, they have $1.1 billion of cash and cash equivalents. In terms of total debt, it's now around $7 billion. And this is from the annual report that, yes, they have like $7 billion and they repaid some of it, but they have nothing major that's due in a single year, like $750 million, billion, 1.2 billion, 750 million, 1.5 billion. So they have nothing major due in a single year. And those companies are cash flowing machines for I should say the brands are cash flowing machines for the company. They have around $1.8 billion. They had an increase in CapEx and many different things for 2024, but it's expected to recover again to $2.3 billion in 2025 and $2.6 billion in 2026. This is massive free cash flow. Even if you count the $1.8 billion, this is still like a 5.4% free cash flow yield. And the dividend yield right now is around 4%. So the dividend is sustainable, and the free cash flow yield is like 5.7%. So they have enough with the cash and cash equivalents to pay the long-term obligations in terms of debt, and enough for them to keep the dividend of 4.2%, which might be very attractive for dividend investors looking for a quality company trading at fair value. And this company, for such brands, such popular brands like Tylenol, Motrin, and many of those brands, they have recognition and have massive pricing power. The company is only trading at 15 times earnings. I mean, 15.8 times. This is not expensive at all for a company that has those brands. I mean, I'm sure the brand value alone for that stuff, if they want to spin off some of them, they're worth a lot of money. And 50 times earnings for this company with such an improvement that's expected for free cash flow, it's not expensive at all, I have to admit. You look at earnings per share growth, it's not the best because they're facing, again, declines. They have to raise prices to offset them. There's a lot of competition in the space. So it's like, I mean, I wouldn't bet more than 6%, honestly. It's between 7, 4, 9. It's very hard to guess that stuff. But I would say around 6% is somewhat visible, somewhat accurate, most likely. So if we get like an average of 6% earnings per share, dividends like 4%, that's like a 10% annual return on the stock, but it's still trading at 15 times earnings. If they have a plan of turning some things around, cutting costs and increasing margins. If they can do it, maybe they can get back to 17, 18 times earnings. So it's not really bad at all. I mean, I see a 10% annual return worst case. Best case, maybe 13, 14%. If the company, manages some stuff a little bit better and, reduces debt, increases free cash flow by reducing interest expense, and does a few turnaround plans in terms of cost, I could see multiple expansion. So for me, Kenvue is a company that's fairly priced. I don't think the company is expensive at all, and I think it's very interesting here. For LVMH, I'm still sitting on the sidelines for this one. I'm still waiting on it. If I get my price $140, $135, as long as earnings aren't down domestically, as long as things are somewhat fair, I'm likely going to be buying the stock again. And maybe I'll sell it later on if it gets back to 180, 185. That's what I did before. And I love getting back into stocks that I sold, so I will likely do it again. And this is just my opinion on two quality stocks sitting at 52-week lows, not financial advice. So thank you again for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. And I'll talk to you in another video.